fairly quick for the lender.
So in essence, though, what we were saying, though, is the lender may get it back. So in essence, they bid on the property, and as I understand it, they can bid like, up to the amount of the mortgage or whatever, but the lender ends up with the property back.
Yes, that's right.
Yeah. Okay.
It could be sold to a third party, but it also could end up with the lender.
Okay. Now, there's also something I've heard of. It's called a deed in lieu of foreclosure. And so I'm wondering, what's the difference, and is that a better alternative to the trustee sale or a foreclosure?
It's a completely different process. What happens in this case is the borrower talks with the lender. Again, they're usually trying to protect their credit by doing this instead of being foreclosed. And so what they will do is offer to deed the property back to the lender, so the lender regains title to the property without going through foreclosure. So it's done by deed. And then once that's done, of course, the lender would own the property. There are reasons that's better. As I mentioned before, it could be better for your credit. But again, these are very complicated transactions, and you have to be careful with it, because taking the property back with a deed, the lender may not be willing to do that, because if there are second or third mortgages on the property, then they take the property back still subject to those mortgages. So lenders aren't necessarily going to want that. And the other thing that could happen is if you don't get all these mortgages cleared up, you could end up having money that you still owed to people after the property was deeded back to the lender. Well, the lender would somebody would owe the money to these other people.
Uh-huh.
So in order to get a deed in lieu of foreclosure to work, you really need to work with, if you have a first mortgage and a home equity line of credit or something like that, you need to work with all of these lenders in order to try to get that accomplished.
Wow. Yeah. Okay. Well, so some people are using this term now, and so they're unable to make these payments. They feel like they're stuck, and so they say they just walk away from the home that has a mortgage. So what does that mean now when they decide to walk away?
Well, I think the first thing is probably going to be the trustee sale, because that's the normal thing that happens again with the residential property. So I would expect that's the process that would be followed. But again, when you just walk away without negotiating or talking with anybody, it's basically going to be a foreclosure or trustee sale, and you're not going to have any input into what happens with the transaction. And there can be some consequences that occur when the property is sold in trustee sale. The junior mortgages, again, if there are, the reason I keep mentioning this is a lot of people recently have bought property where they don't just use one mortgage.
Right.
They have a first mortgage, and then they have a second, or they have an equity line of credit, which is another kind of a second. And so you have these other mortgages that are there, and they're part of maybe even the original purchase. So again, depending on whether it was part of the original purchase, so it was purchase money or not, sometimes people add these equity lines of credit later. If there's a trustee sale and the property goes away, the second mortgage holder may be able to still pursue you for a deficiency. They don't have any security anymore in the property because that's gone, but they still have a note, and they still have a potential cause of action against the borrower for the deficiency amount. So, it's something that happens in these situations. People have, told stories about, seeing the key in the front door of the house and people just left it.
Yeah.
And it does happen. Another way this happens, and I'm not recommending people do this, but another way this happens is sometimes people, what they call it, fail and flee or something like that, where they will actually negotiate the purchase of another property that has a lesser mortgage because the housing values have dropped. And then once they have that transaction closed, they'll default and walk away from their original house and move to a new house that has a lesser mortgage. And that's a type of walking away that I'm not saying it doesn't have any negative consequences, but it's something I think the lenders are also aware can happen, and they're watching out for that possibility as well.
Okay. So we're in this big round of downturns, where people are losing their homes and so forth recently. And we have sort of a new term that's come up that I didn't hear very much related to housing before, just the last year or so. and it's the short sale. So what is a short sale, and is it a better alternative than a foreclosure?
Right. Well, short sales, as you said, they used to apply more to stock transactions and things like that. But they've been around in real estate transactions for quite a while as well. I think they probably were more prevalent in commercial transactions and maybe in other markets, because we never had a market where the values have dropped like they have. So basically, the way we got into this big mess is that people, basically lenders and borrowers, believed that the values were never going to go down and could only go up. Well, a short sale occurs when you have a property that isn't worth as much as the mortgages that are against it. And so again, what happens is people, in order to try to protect their credit, might go to the lender or lenders and say that they would like to sell the property and have the lenders agree to take the proceeds of that sale as satisfaction of the debts that they have against the property. And lenders might be willing to do that because it saves them from going through the foreclosure process. It depends on the relative value of the property to the mortgages and all that. But essentially, if you get the agreement from the lender that they're going to be willing to cooperate with that, then you market your property for sale and get the highest price you can get for it. And then a part of that transaction would include, if you're going to do this correctly, would include documentation that said that this was going to satisfy the mortgages. And again, it's multiple mortgages, because you don't want to have your first satisfied with a short sale and not have seconds and thirds satisfied. And you don't want to enter into a short sale where the lender just says that they're going to be willing to release the lien against the property so you can close escrow without their agreement to not pursue you for any kind of shortfall. Because you're not, in this case, you're not going through a foreclosure, you're actually selling the property. And so the anti-deficiency statutes and things like that we're going to talk about in a minute are not necessarily going to apply in the same way in this voluntary transaction with the lender and the borrower.
Right. So that's one thing that's going to be, I think, really important, is that anti-deficiency aspect. So we'll talk about that in a moment. So now we've got a short sale, or we may have a foreclosure. What happens for the second and third deed of trust holders in these types of scenarios?
Right. Well, we've talked about that a little bit in the other context, but basically, if you're going to do these transactions, you want to the maximum extent that you can, have them as part of the process. And with the values being so low, this can be very difficult, because sometimes with the market value being lower than even the first mortgage, you're not going to have enough money ever to satisfy seconds and thirds and things like that. And so, what actually can happen in the context of a foreclosure is that the second and third mortgage holders, they don't just disappear, unless we'll get into this non-recourse financing a little later. But if for some reason it's not non-recourse financing, they may lose their collateral, which is the property, but they aren't necessarily prevented from at some point trying to pursue their note against you. And so it could end up, if you don't get this all bundled up together, you could end up in a situation where you've lost your property, you're still having trouble with your debts, you still owe money to lenders, and you're basically insolvent. And again, we can talk about that a bit later as well. But when you're insolvent, and you may be facing bankruptcy, then the question may be, why did you go through all of this, to get to that point? You were trying to protect your credit, you were trying to improve your situation, and you could ultimately end up in the same situation that you were trying to avoid anyway. So the key here is that anytime there's more than one mortgage and you're trying to negotiate something, they all need to be included to the extent that that's possible.
Okay.